Hello there, you're listening to our Monday minisode, and today it's our monthly tax topic with Simon Misiewicz from Optimize Accountants. Once a month, Simon and I pick a tax topic to talk about with one eye on those of us based overseas. And if you'd like a free PDF guide to this month's tax topic, click the link in the description or go to expatpropertystory.com. Now, let's get into today's topic. Section 24.
So Section 24, mortgage interest relief cap. What does this mean? For landlords, it means that you cannot offset mortgage interest cost or refinance costs against your rental income. HMRC will tax your gross profits. And I'm referring to gross profits in terms of you might have rental income, but then you've got refurbishment fees, repairs, maintenance, and letting agency fees, which then gives you a gross profit. Now, that gross profit is what's then going to be taxed by HMRC and not the net profit, which is gross profit less the mortgage interest cost that you suffer at the hands of the banks. So let's imagine that you've got £100 worth of rental income and your mortgage interest cost is £30. Now, your profit is 70 in simple terms. But HMRC will say, well, we're going to ignore the mortgage interest costs as part of Section 24 mortgage interest relief cap, and we're going to put you at the £100. Now, if you're a basic rate taxpayer, that's obviously £20 tax. If you're a high rate taxpayer, that's going to be £40 because it's 40% of the £100. Now, don't fear. I mean, you do get some tax relief on the mortgage interest costs that you have suffered. But please note that it is only going to be tax relief at 20%. So if you're a basic rate taxpayer, you're probably thinking to yourself, well, Section 24 doesn't affect me too much. And you'd be largely right. There are some nuances that does affect basic rate taxpayers as well.
Section 24 is more of a concern for higher rate taxpayers. Let's sum it up just to keep everything crystal clear. Pre-Section 24, mortgage costs for individually held property were fully deductible. Post-Section 24, the relief for mortgage costs was reduced from 100% to 20%. Remember that in Simon's example, the mortgage cost was £30 per month, so the 20% relief on £30 is £6. So for a lower rate taxpayer, the maths is £100 minus 20% tax, so minus £20, plus the 20% mortgage relief at £6 equals a £14 tax bill per month. So in this example, the lower rate taxpayer pays £14 per month, leaving a monthly profit of £86. But for a higher rate taxpayer, it's £100 minus 40% tax, so minus £40, plus the 20% mortgage relief at £6 equals a £34 tax bill per month, leaving a profit for the same property of just £66 per month.
For high rate taxpayers, additional rate taxpayers, that's a considerable amount of tax that you're going to be paying more as a result, because you have this 20% tax relief, but you've paid £40 worth of tax. So technically speaking, it's only 20% of the mortgage interest cost. So in the analysis I did, you might have suffered £40 worth of tax on the £100, and you might get £6 tax relief, which means that you're paying a net now £34 in my scenario. And for many people, when they're saying that I'm a high rate taxpayer, in that example, your tax position, if you look at the amount of tax you paid, which in this regard was £34, against your tax bill, you can see that actually you're going to be paying a lot of tax. So, and I'm talking about gross income, that people look at that and they'll say, well, it's 34% of my gross income. So that's fine, because that's what they're looking at tax return. So your actual profit of £70 when I take all the expenses out, but you've got a tax bill of £34. So the percentage of that is now 49%.
Section 24 is even more of a concern in higher value areas of the country.
Let's imagine that you've got a property, let's say that's more expensive. So we're talking about areas of Surrey, London, the South, Portsmouth, Southampton, that kind of area, whereby your property prices are quite high, potentially against your rental income. Now, in that scenario, I did the same analysis whereby you might only get £100 gross profit, again, looking at your rental income, taking off the letting agency fees, taking off the repairs, maintenance, all that kind of good stuff, you might still be left with £100. But because the mortgage is so much higher, the amount of interest could be significantly higher as well. So in this example, I was saying that someone might have a tax interest cost of £70, which means that net profit on that property will be 30. Now, without going into too much of the detail, but the tax position of that particular client, the HMRC will say, well, again, I'm going to ignore this £70 worth of interest and I'll look at your gross profit and I'll tax that first. The net position is that that person will still suffer £34 worth of tax. But wait a minute, there is a bigger problem now, is that the £34 worth of tax is more than the net profit that that landlord has made. So the net after tax position is minus £4. And this is one of the big areas of portfolio reviews that we try and do with our clients, is to say, well, who is now making money out of property? Is it you, the bank, or HMRC? Because in this scenario, we've got this position of gross profit is £100, and this is gross profit, not net profit, but gross profit is 100. The banks are taking 70, and HMRC are taking 34. And what you're having to do from the net profit is actually give £4 to HMRC. So that particular property or portfolio or that landlord is in a loss-making position. The bank and HMRC rubbing their hands together because they're the ones making the money. You, the landlord, because of Section 24 mortgage interest relief cap, is going to be making a loss. And we've seen this actually with some of our clients. The worst case scenario I saw was 165% tax.
Want the full story behind this? Head to expatpropertystory.com to listen to the full episode.